Sin duda, el sector financiero ha vivido un gran cambio en los últimos años. Tradicionalmente, todas aquellas personas que querían pedir dinero prestado o que le prestaran ese dinero acudían principalmente pues, a los bancos. Era la vía extensiva por la que se pensaba. Pero debido a los fundamentos macroeconómicos, a la crisis de 2008 y también a la crisis derivada de esta pandemia, las cartas del juego han cambiado. Los bancos centrales en ese momento pusieron una enorme cantidad de dinero a disposición, lo pusieron en el mercado, pero a coste cero. Y esto, sin duda, ha tenido consecuencias. Las consecuencias más claras: los márgenes bancarios se redujeron drásticamente, por lo que los ahorradores no obtuvieron ningún beneficio por sus depósitos. Y esto ha tenido otra consecuencia. Los bancos tenían miedo de la calidad de esa deuda, por lo que se volvieron bastante restrictivos y también selectivos a la hora de prestar ese dinero. Así que, llegados a este punto, empezaron a aparecer otros sistemas para prestar y tomar dinero prestado, principalmente basados en las nuevas tecnologías. ¿De qué estamos hablando? Estamos hablando del FinTech. Apareció hace 12 años y ahora ya es una industria consolidada, es una industria enorme y bastante madura que actúa en los diferentes continentes, pero sin duda no hay que olvidar el sistema tradicional, los bancos, porque es ahora mismo la mayor parte de la industria, pero tampoco es la única. Nosotros ahora vamos a abordar estas cuestiones. Esta va a ser la temática en la que vamos a ahondar en la próxima hora y lo vamos a hacer con Peter Renton, es cofundador y presidente de LendFintech. Los vamos a tener en este caso, ya sabéis que este evento es híbrido, combina lo presencial con lo online y en este caso nuestros 4 ponentes y también el moderador van a estar a nivel online y los van a poder seguir desde esta pantalla. Como decíamos, Peter Renton va a ser la persona que va a moderar este debate. Con nosotros los ponentes van a estar David Noguera, subdirector general y director de financiación estructurada del Banc Sabadell, también Beth Crosby, fundador y CEO de Pear Street, Jaume Martínez, jefe de finanzas alternativas de Stonebeck. Así que les doy la bienvenida, les saludamos desde ese plato de Vineu Real Estate y les dedicamos ya todo el tiempo a que nos expliquen estas nuevas tecnologías aplicadas al FinTech. Muchísimas gracias.
Okay, I think that's our cue. Buenos dias, everybody. My name is Peter Renton, Chairman and Co-founder of FinTech. Unfortunately, I don't speak Spanish, but I'm delighted to be here today. We have a really fascinating session, I think, planned. We're going to talk about real estate, FinTech, and other ways to fund your projects. Let's just get started with a quick introduction for everybody. If we could just go around and tell us sort of what your company does and what your role is in your company. And David, I'll start with you.
Yes, I'm David Noguera. I'm the head of structured finance of Banco Sabadell, and my scope is to finance structured financing for big deals. And inside these different specialized teams, we have commercial real estate is one of these deals, and then there is we have track record in different countries where Sabadell has a bank or has a full branch.
Okay. And Jaime, you're on mute.
Thank you. I'm Jaime Martinez. I'm head of alternative finance at Stonebeck. Stonebeck is an integrated real estate asset manager with close to 4.5 billion euros of assets under management. We invest across a variety of strategies in equity and direct real estate investments and debt, which is the part that I head. We are focused mainly in Europe. We are present across 7 countries in Europe and also in the US.
Okay, great. And Rod?
Hi, Peter. I'm Rod Lockhart, CEO at Lendervest. Lendervest is an asset management platform focused on property finance in the UK. So on one side of our platform, we're providing landlords and developers with investment loans, development loans, bridging loans. On the other side of the platform, we have investors from all over the world, including banks, institutional investors, private investors, investing in the loans that we originate. And really holding all of that together is a proprietary fintech platform, making it simpler to either borrow from us or invest into our loans.
Okay, thanks, Rod. And Brett?
Buenos tardes. I'm also going to do it in English. I'm Brett Crosby. I'm the co-founder and chief customer officer of Peer Street. Peer Street is a platform for investing in real estate debt. We've got investors on one side of our technology platform, and we connect those investors to investments in loans that are sourced from a national network of private lenders who focus on short-term bridge loans to finance the rehabilitation of residential properties, typically. And the borrowers on that are real estate entrepreneurs that want to go and fix up a property, excuse me, and either sell it or get longer-term financing and turn it into a rental property. We've been around in the U.S. for about 7 years now, and we've done over $4 billion in loan volume at this point, and are continuing to grow. And hey, it's an honor to be here. Great to see you all.
Okay, so let's get right into it, and I want to really kick it off with talking about how you're funding your projects today. And I'd like to, maybe you could even give us examples of recent, of a recent deal or a group of deals that you've done to sort of let the audience know the segment of the market that you're in and the kind of investors that you're working with. And David, let's start back up with you.
Okay, well, I represent the classic way to finance, no, in this panel. But Sabadell covered in the real estate market in Spain, UK, and Mexico. I think there are the main market from Sabadell. In these markets, Sabadell has a bank. Then we try to provide all the services. Also through our network of international office, additionally we can cover French, Portugal, United States, Peru, Colombia, and some cherry picking in Caribbean. More focus abroad, more focus in commercial real estate. Always doing structured financing with tailor-made structure, etc. But mainly in the classic way, except other things I will comment later.
Okay, so is it mainly securitization that you're doing to fund these deals? Do you hold them on your balance sheet?
No, yes, we do some securitization, but the traditional way to fund is more with the deposit of our customers. Now, also we have securitization, have about capital markets, etc. But it's a mix.
Right, got you. Okay. And Jaime, how are you funding your projects right now?
Well, so the alternative finance practice at Stonebeck operates effectively as a debt fund, right? That's what we are. We have an investor base which is made up of mainly of private wealth managers and also selective institutional investors. We have, I would say, on one side, we have a discretional pool of capital structured in commingled funds that at the moment have a mandate for bridge finance in Spain, where basically we are looking for short-term 1 to 3 year loans with first lien mortgage security, and looking for low double-digit returns, effectively to finance land and transitional assets and development as well. And these funds get basically funded in a traditional fundraising process where we raise capital amongst our investors, and then we deploy it as we see it fit with a typical fund governance structure. Now, I think what's interesting about the way we operate is outside of this pure bridge mandate, which is quite focused on Spain and a bit restricted, we are able to work on a deal-by-deal basis, on a non-discretional basis, basically coming up with selective transactions that then we introduce to our investors and then effectively make them happen, essentially putting together like a club deal, right? We've done that a number of times. We've done that recently in Spain. We closed, for example, a corporate financing for a mid-sized developer from Madrid back in July. That was a 10 million euro loan that we closed successfully, and we basically structured that and placed that in that particular case amongst 5 of our investors. No? So that's something that we're used to, and we are flexible, and we can do it. No? Not everyone can do it, but we are happy to operate that way. No?
Okay, great. And Rod, as far as from Lendervest, tell us a little bit about. I know you talked about the different types of investors you work with, but maybe you can just go through a bit more detail on how the money flows through to the projects.
Yeah, just before I do, Peter, I think it's probably just worth highlighting. Lendervest is a UK-based business, and we're lending in the UK, and we're mainly lending against residential property or property that's being developed for residential. In total, we have around £3 billion of funds under management. The vast majority of that is from institutional investors, but we also have financial partnerships with banks, as well as private investment with a small amount of investment with private individuals as well, so private investors. And I suppose one of the things that makes our platform pretty unique is these investors will invest with us in a whole range of different ways. So, we're an asset manager, we're a fund manager, we manage funds and separate accounts. So that's one way in which investors might access the loans that we're originating. So either in commingled funds or separate accounts. We issue securitizations. So we've securitized portfolios of buy-to-let mortgages, and we have, investors like PIMCO, BlackRock, M&G, Aviva, big sort of institutional investors buying bonds in our securitizations. We also, issue whole loan bonds as well, which we have listed on the London stock market, and those bonds are available not only to institutional investors, but retail investors can buy in retail volume those loans as well. So we have a whole variety of different structures, allowing a whole variety of different investors ultimately to access loans that we're originating through our platform.
Right. Got it. Okay, Brett, so I'd like you to contrast what Peer Street does versus what Lendervest does, because you are structured quite differently. So maybe you can tell us about that and how you're funding the projects on your platform.
Yeah, sure. So Peer Street, as I mentioned, is this platform. It's a technology platform designed to connect a previously very inefficient marketplace. You have investors on one side, and these are both institutional investors as well as individual investors. And historically, this was a very institution-heavy asset class. Basically, just institutions had access to this asset class, which are short-term loans against residential real estate. And what we have done is made it so individuals like you and me can go on the platform, create an account, fund your account, and then invest in these loans for as little as, it's now down to $100 with a reinvestment. It's $1,000 to create an account. So very low bar for entry, especially compared with historically how it's been. And then people can go on there, pick and choose their deals. It's not a fund. You can basically create your own fund and pick and choose what you want to invest in. And then that capital goes into these loans that we then are purchasing from our national network of lenders. So we have hundreds of lenders that we work with. The way we're different than Lendervest, first of all, we are US focused rather than UK focused. Secondly, instead of going after borrowers directly, what we found is there in the US market, at least, there are thousands of private lenders out there. And the real issue is that they don't have access to capital the same way banks do because they don't have depositors. And so historically, it's been very inefficient for them to be able to raise capital. They have to go find wealthy individuals or institutions that they can work with, but it's hard for them to get big enough to attract institutions. And so we saw this massive disconnect between capital and being able to deploy capital through these lenders out to borrowers. And so for us, the way to scale and scale efficiently and with high quality, we saw the opportunity to connect with those lenders. And we built out all these tools for those lenders on our platform to be able to upload their loans and in fact, all these tools to actually help them make loans much more efficiently than they could in the past. And then those flow through to the investors. And so really both sides of the platform are happy with that model.
Right, gotcha. And full disclosure, I should also say that I've been an investor on Peer Street as an individual for about 5 years now, and anyway, have a great experience there. So good plug for you there, Brett.
Thank you.
So, David, I want to turn back to you. I mean, you're the traditional bank here. I'd love to kind of get your sense on, you see the fintech markets. You've listened to some of the fintechs here. I know there are fintechs operating in the regions that you operate. Do you feel like you're in competition with the fintechs now, or are you trying to work with them on deals?
It depends. I remember I had a teacher at the university said an economist always answer it depends. But let me explain. If you use topic, fintech, specialized funds, specialized investor are always more agile and less regulated than a commercial bank. They have a great knowledge about the sector specialization, and usually they use the latest technologies to be more client-oriented, customer-friendly, and also, and very important, with a better decision process or more agile decision process. No? On the other hand, commercial banks like us join their customers in their business and offer a more global product coverage and services, and usually look for a long-term relationship. But taking into account this different approach, I would say sometimes we compete and sometimes we become big partners with a blended solutions. And I think the good news, if we look 10 years back, the good news is today on the market there is different more money in the market. It's more different, and we all together we can cover, I think, all the needs. For example, commercial banks, for all this regulation, for all these things, we have a very narrow window in terms of risk return. That means, with an example, that means, for example, in my opinion, if you are talking in real estate, if you are talking of a construction period plus ramp up, in this period, I think commercial banks can offer a very can do a very competitive offer. If we are in the early stage, as Jaime said before, if you are talking about development, land acquisition, project plan, urbanization, there is some specialized funds who can provide better offer. On the other hand, when we talk about prime place with a consolidated assets or with a track record, then insurance companies, pension funds, fintechs, I think that they can offer better price and better maturity. Then this is reality. This is a reality today, no. But in our case, we are stuck to some financing. Combine the two worlds. Construction loan provided by commercial banks plus long-term facility provide, but non-lender banking, another investors, etc. If when we combine two worlds, we can achieve a better offer.
Right.
Then at the end of the, in my opinion, at the end of the day, the customer and the markets looks always for the most efficient offer. And which is the point? Sometimes these offers will be banks, sometimes it will be fintechs, and sometimes the blend solution will be better.
Mm-hmm. Okay, that makes sense. So I want to flip to the other side of the coin here and go to Rod, because I was reading just last month you guys closed a deal with the largest bank in the world, or at least outside of China, the largest bank in the world, and with JP Morgan Chase I'm talking about. And interesting to see, I mean, this is obviously a bank that has multiple trillions of dollars in assets, a massive workforce, massive resources. How were you able to partner with them, and why did they decide to do business with you?
Yeah, Peter, you're right. It is really interesting. So, on one hand, when we're lending, we're often competing against banks. And then on the other, we have partnerships with the likes of JP Morgan, which we relatively recently secured. It's a £725 million separate account, into which we're originating and managing a pool of buy-to-let mortgages. And sort of when I think about it, probably the easiest way of describing why a bank might partner with us in our lending, we're providing them access to a loan type, an asset class, a risk return point that they wouldn't otherwise be able to access directly themselves. And with JP Morgan, it might sound bizarre. JP Morgan, as you say, biggest bank in the world, partnering with Lendervest, but they don't have a mortgage lending business based in the UK. So through Lendervest, they can access buy-to-let mortgages in volume, which is clearly, if you're a big bank, really important. So hundreds of millions of pounds worth of exposure. But equally, we have our other banking partners. So we work with Barclays and HSBC, two of the largest mortgage lending banks in the UK. And interestingly, when those banks partner with us and invest into our loans, they're doing so not into our more standard mortgages that might cross over with some of the loans that they originate, but they're investing in transitional assets. So similar to the assets, the loans that Brett described, where borrowers are repurposing underlying real estate on a short-term basis before flipping it or refinancing. They can access those. If they access those loans directly with us, they get exposure to our underwriting, our ability to originate. They don't have to have any of the infrastructure involved in originating and managing and understanding those loans. It's an efficient way to access exposure to those assets. And I think that probably hopefully describes why banks might choose to partner with fintech platforms, but on the same hand, may be competing with them in some areas as well.
So yeah, because I mean that's the thing that's interesting to me is HSBC and Barclays, then they could potentially originate the exact same assets you're originating, right? Like they must decide it's easier and cheaper to do it with you. Is that really the bottom line? Yeah,
I partly. Pre-2008, maybe these banks would have, lent money to these to the small property companies that are borrowing money through their branch networks across the UK. Clearly, 2008 interrupted their activities pretty drastically. And you fast forward to today, that branch network doesn't really exist. In the UK, we don't have bank managers in individual branches across the country that understand the borrowing needs of the small property companies that are looking to borrow from them. So the whole origination infrastructure that the banks once had to cater for that small property company has disappeared. And really what our platform provides is an opportunity for banks and other investors to access that the loans from those property companies.
Interesting. Okay, well, Jaime, I want to turn to you and talk about Stone. You said you've got 4.5 billion euros under management. I think you said. I mean, how do you decide what real estate segments to really focus on, and also which countries across the different countries you work with? How do you decide which segments within which countries to focus on?
That's a very tricky question. I think We have historically used a motto which I think represents that very well, which is that our product is the opportunity. That's what we like to say. So the reality is that the way the firm has been expanding progressively has always been based on, if you want, with an opportunistic approach. That's really the way we've done it. Strategically, I think we have been moving into different areas as we, from a strategic perspective, thought that the opportunity was there and it was the right thing for us to do. That's really how the firm, in the first place, how the firm started doing direct lending and bridge finance. That's really the way we got into this business. And outside of the bridge or the debt side, which again, it's not my field, but outside of that area, in the most like direct equity side, that's how we got into develop of PRS in Spain, which is a big thing for us at the moment, and the hospitality strategy that is also a big thing for us at the moment, and or PRS strategy in the US as well, which we are quite strong there, and we have quite a strong presence on that side. So I think to answer your question plainly, I think we do it on a case-by-case basis. Basically, just thinking about what is it that is best for our client base, for our investors, and how do we service them better. No, in the debt side, I think we obviously base what we do on the type of returns and the risk appetite that our investor base has. We are a bit of a traditional debt fund, as I said, on that sense. And I think it's very interesting to see players or new players and more flexible and more platform-based players like Peer Street or Lendervest coming into the market. No, the reality, I would say that when I started in this business some time ago, I think crowd lending platforms and diversified lending platforms was like a new thing coming to the market. I recall having conversations with some guys where you were like discussing things that sounded a bit like a funky new thing coming to the market, and now you got people like Rod here who's managing 3 billion euros, right? So I think that's a big thing about how this industry is changing. Aside from from that secular concept of finance de-intermediation, which is a big thing, and it's a big topic, and also the declining role of the banks in the finance market, with more and more. I think where this is going is that Europe and Spain, for that matter, is going to resemble more and more markets, or more developed markets like the US there. No, I think that would be my takeaway.
Okay, thank you. And I want to turn to Brett and talk about the US market. We've had a pretty crazy 18 months since the start of the pandemic, where we thought real estate was going to be dramatically impacted in a negative way, and it actually has proven to be the opposite. So maybe you could tell us a little bit about how that's impacted Peer Street, Brett, and how that's impacted in particularly the deal flow that you see on your platform.
Yeah, definitely. It's been a wild time, I have to say. In the 7 years doing this year, we've seen the tightest credit markets and then the loosest credit markets, all in the course of, and it was probably in the course of about 6 to 8 months, really, that happened, which was quite wild. And we built this platform to be resilient and to keep capital and have diversified capital as much as possible on the investor side of the platform, and then diversified opportunities for investors with loans and lenders and geographies, risk profiles, all of that stuff on the other side for investment opportunities. And so we've really built it to withstand a situation like this, but this is such a unique one. And of all the things we expected, I think a global pandemic was probably not top of the list. And so what we saw right when COVID happened, we saw an extreme tightening of the credit markets. And basically, in many ways, markets completely shut down. And when that happens, knowing how to value an asset, almost any asset, is nearly impossible for a short period of time until things start to normalize. And so that took some time. It took probably a couple of months, I would say, maybe 2 or 3 months until people started to say, okay, what are assets worth? And like, for example, the day before things shut down, you could get a valuation on a property and you'd be like, okay, I trust that valuation. The day after it shut down, you're like, I have no idea if this valuation, is real anymore, because what are homes worth now if nobody's working for a while, et cetera? Well, as things started to normalize, capital came flooding back into the system in incredibly large amounts from individuals, but also institutions. And on the previous question, we do have large banks that buy from us. And most banks don't actually originate these types of loans that we're working in, but they like the asset. They're comfortable with the asset. So we've seen all of that capital come flooding back in. And then what happened is that capital came flooding back in. Interest rates were very low, and there was a moratorium on evictions and foreclosures. And so at first, we thought a lot of our loans were going to start, or some of our loans were going to start to go bad in bigger numbers than we'd seen before. Historically, it's been a pretty low rate of default where borrowers stop paying, and very low rate that we've had to actually go in and foreclose on properties. We were very concerned that was going to spike because, of the obvious situation. But what happened instead, to your point, is the real estate market took off. And there are a lot of businesses that did well. The two kind of businesses that did great are technology businesses and real estate. And we're right in the center of those crosshairs. And our business really came booming back. And we saw, partially because of housing prices going up throughout the country, we saw our portfolio where we saw loans that we were worried were not going to do well. They started paying off, and the borrowers were like, oh, actually, no, I can finish this project and I'm going to pay off the loan. And here's, some additional fees that because I was a little late or whatever. So it's turned out to be fairly positive. Not everything perfect across the board, of course, but generally we've seen everything trending in the right direction. The one thing that's interesting, though, Peter, that I think a lot of people don't realize is that because there was this increasing housing prices, because there was so much capital available for borrowers, meaning interest rates were very low, and in the U.S. at least, there were a lot of government programs to, even if people stopped working, they were still getting paid not to work, all of those things. And it caused actually, even though prices were up, there was a lot less volume on the market. And part of the reason for that is people were afraid to put their own house on the market because they didn't think they'd have a place to move into. All of those things caused prices to go up. They caused, a lot of demand in the market. And now what we're starting to see is, as some of those programs are unwinding, there will be, my prediction going forward is that there will be a lot more supply coming into the market from distress, but also because people will be like, okay, now there's more supply, so I can now sell the house that I was thinking about selling because I can buy something. So I think you'll start to see things settle over the next year, but how quickly things will settle and kind of return to normal, we'll just have to see.
Okay. So I'd like to actually hear from others about the impact the pandemic's had. I mean, here we are funding real estate projects. It's typically been a pretty cyclical type of business, but would love to kind of get maybe David, you can start with sort of telling us about how the pandemic has impacted your business, particularly when it comes to deal flow.
Obviously, the pandemic impact all of us. That is clear. But as we know, in the markets where we have presence, the effect has been less than the initial previsions, and I think that it's very good news. We foresee a V shape with a huge initial impact in the lockdown, and then with a very quick recovery. For example, if we talk in our main market in Spain, the sales in the property market in certain place rose 2019 levels. And if we are talking about our deal flow, about our portfolio, 2021 portfolio in our teams about commercial real estate portfolio, I think it's a surprise. We are over budget in this sense, because the reality is the prime places with or the projects who make sense, I think, is there is the deal flow don't stop. Obviously, is not general. No, in the sense of perhaps I'm thinking in logistic commercial real estate, in logistic, in health, some office, not hospitality. Hospitality now it's have another. I think it needs more time. But at the end, I think we have we are combined, and we strongly believe in the recovery of the sector. But we are a little surprised with with this year.
Right. Okay. And Rod, was that the same? Is it similar?
Yeah, I think from a market perspective, I mean, Brett described, clearly talking about the US market, but you could have just called it the UK market, and it would have been almost exactly the same. I think in terms of specifically around Lendervest, when we were, as all businesses, suddenly hit by this pandemic, and one of the things that really I suppose we were differentiated by was just operationally. So, suddenly everyone moves to remote working. As a technology business, we took our laptops home and we carried on. And in March 2020, we lent over £180 million of loans in that month. We weren't interrupted from a operational perspective in a way that traditional lenders were. I'm clearly, as the months then went on, valuations became harder to do. We tightened appetite, and the amount we were lending reduced. But because we were able to stay open, we actually found we took market share. And when the markets reopened, property market in the UK reopened summer 2020, we'd stolen a march on our traditional competition, and so clearly we wouldn't have wished for the pandemic, and as I said, we went through a slower period when property markets were hard to transact in, but when we came through it, we'd stepped ahead. And I think a lot of businesses, I suppose, caught up and learned how to digitize processes over that period. But we certainly benefited from having a digital lending process when we were going through that time.
Right. And Jaime, did you pull back from the market for a while? And what did your investors? I presume some of your investors were nervous. So tell us a little bit about how that.
Yeah, it was quite it was interesting because I think at least from our side, and I guess it was also the same thing for the hordes of alternative lenders out there. I think in our case at least, we saw reluctance from investors to make new commitments when the whole lockdown kicked in last year, as you can imagine, and that did affect our progress in fundraising in some of our vehicles, I have to say. It was something that was temporary. It was not like a big thing for us, but I have to say it was somewhat meaningful. From the market perspective, from the perspective of origination of new deals and everything, I'm totally with David in the way he perceived the way the market has been seeing and the expectations in the market, in particular in the Spanish market, which is the most important for us at the moment. It was very interesting to see the evolution of the expectations, amongst the market players, and how that translated into quite a particular dynamic in the sourcing of opportunities for us. No, just bear in mind that our business is a bit complementary to that of the banks. So we don't compete with the banks when we lend. We just structure deals where typically banks don't come in, or banks are going to come in later or something, or we complement bank financing with a subordinated tranche or something like that. So what we saw is we had quite an abundance of opportunities in the second half of 2020. And I think that most of that had to do with people that was working on transactions and got the financing frustrated and then had to resource to alternative lenders. So we saw quite a few of that, and we actually struck a few very good deals ourselves back in that period. And then we saw a period in the first half of 2021, first half of 2021, where people, I think, was expecting for things to get better, but still were not getting better yet. So it was quite hard back for us to strike good deals on that period, because the expectations were a bit mismatched with reality, and that made finding a balance and finding an equilibrium point when you want to strike a deal, that made it quite tricky for us. It was difficult, and now I'm seeing again that the perception of the market is actually getting better and better, and that's somewhat matched to a certain extent with some reality bites there. I think the market dynamics and the momentum is certainly improving, and it's also translating into some transactional and investment activity, which obviously helps our business as lenders, no?
Right. Okay. So we just got a few minutes left. I want to end with sort of a forward-looking discussion, talking about what the future holds. I mean, what changes do you see coming down for real estate, and particularly how deals are funded in the future? And Brett, why don't we start with you?
Well, thanks, Peter. It's been, as I had mentioned, it's been a wild ride. We continue to see more and more capital coming into the system. And as a lot of the regulatory changes that were made to help people during COVID are sort of unrolled a little bit, and people are back on their feet, we expect to see a lot of volume come back into the space. And we see that as obviously very, very positive for our business and for our investors, and for the whole real estate community, really, because when someone invests in a loan on Peer Street and through most of these platforms, what's really happening is that goes to a lender that is able to make another loan to a borrower. And what those borrowers are doing are they're finding properties that are typically in distress, meaning if you live in a neighborhood and you have a crummy house on your block, one of these borrowers goes and buys that property. They fix it up and they turn it into a nice house on your block. And so that's a good thing for our investors, a good thing for the borrower, it's a good thing for the lender. Those are all the participants, but even for the non-participants, everyone else who lives on that street gets the benefit of their neighborhood being improved. And if you do that once in a neighborhood, great. If you do that hundreds of times in a community, you can really turn a community around. And that's what we're doing. We've done over 10,000 property loans. And so we really see the impact happening on a national basis. We're just looking forward to continuing to grow that. And then where do we go from there? We continue to roll out new loan types so that more and more borrowers have access to more capital.
Right. Okay. Rod, turn to you. What's the future holds for Lendervest?
We think technology will continue to have a pretty significant impact on the market. Making it simpler for borrowers to access finance when they want to access, quicker, more transparent lending processes. And I think that's clearly sort of was accelerated through the COVID period when technology had to step in and solve processes. But I think that there's a long way to go. There's a lot of friction in the property lending process. This isn't an easy thing to do. There's not a one-touch mortgage, and so there's years of reducing friction in the property lending process to come. And we see a lot of value in keeping chipping away at that. That's what we're here for. And we also expect banks to want to continue to partner with fintech platforms so they can benefit from all the investment that we've made in technology, and access loans in that way.
Right. Right. Okay. David, what about for your bank? You're on mute. David, you're on mute.
Sorry. I said Rod said exactly the main message. I want to say technology, the accelerator of the COVID, and only I can in addition I can say I think there will be a space for all of us, for all the different source, because altogether, I think my opinion is altogether we can offer better offers and better solutions. Obviously, in certain targets or in certain sectors will be more friction, but I think at the end and altogether will be more sophisticated and more specialized even.
Okay, great. And Hameh, last word for you.
Thank you. Yeah, I think, well, from our side, I think clearly, I mean, our future is about expanding or a strategy or based off of different strategies for our investors and jumping into doing new things, new geographies probably, and new verticals. I don't think we have anything in mind at the moment, but I'm a very strong believer in the relevance that this type of technology-based platforms are going to have a role in the future. I'm totally into that, and I think that's going to be a big thing in the years to come. I wouldn't be surprised if at some point we actually get to partner or to do something with one of those guys. Not that we have anything in mind at the moment, but I really think that you guys are going to play a big role in the future.
Okay, well, we'll have to leave it there. Gentlemen, thank you very much. It was a fascinating discussion. Thank you, the audience, for watching. And it's going to watch this space. It's going to be really interesting to see how it all unfolds.
Thank you,
Peter.
Thank you.
Muy buenas, el mercado inmobiliario se está moviendo a pesar de que el sector bancario tenía la idea de que podía enfrentarse ante impagos, morosidad. Decían que pensaban que podía suceder eso en el sector, pero no ha sido así. Despuntó, decían, el sector inmobiliario por detrás del tecnológico y eso son noticias positivas. Acabamos aquí porque ahora nos preparamos para la nueva sesión, para los premios que se va a dar el BNIU a las empresas más innovadoras de cada uno de los sectores presentes, las startups más reconocidas de esta segunda edición. Así que ahora mismo volvemos.